And you look at the daily interbank FX rate from the Bank of Ghana. If you go to the Forex Bureau on the retail market, the dollar going for as high as 8 cedis 99 pesos. That's just a peso shy of 9 cedis. Well, local manufacturers are warning the industrialization agenda could be under threat if challenges confronting the cedi are not fixed. They say the operations have been gravely impacted by the cedi's decline in value and are calling for swift action from government to stabilize the local currency. Take a listen to Business Development Manager of Iron Steel Manufacturer B5 Plus Limited, Sandeep Solan.
Seriously, the CD depreciation is affecting us a lot because, we are importing most of the items and every day we cannot change the price. Being a buyer, you will not accept every day I'll tell you that the prices have gone up. So we have to seriously think before doing the pricing because we have to see past prices, we have to see upcoming prices, we have to see what is on the sea. So it's really a big challenge for us to do the pricing, but at the same time we have to see our users. We should not affect them directly because they are also, using it. So keeping all those things in mind, our chairman is always taking just steps to cover. Maybe our profits should be reduced, no problem, but we have to serve the society also. So we are just trying our level best how we can cope up with this situation and looking at the futures, like maybe the future will be better. I think government has to fix the CD rate somewhere down the line because this is something very key to any business, just not steel industry, any steel industry or any industry. CD rate has to be, come to some point where it has to be fixed because if we are changing the CD rate every day, it is affecting everybody. So I think some solution has to come from the government side only.
Well, so the local currency has lost nearly 29% in value to the dollar since January. The situation may even be worse due to the downgrade of the country's credit rating by S&P, a situation which may force some foreign investors to liquidate their investments. Now, President of the Association of Ghana Industries, Dr. Humphrey Dake, joins us to talk a bit more about this. Thanks for your time this afternoon. Just how seriously is industry being impacted by the city's decline in value?
Good afternoon, and thanks for the opportunity. Well, as stated by yourself, the extent of depreciation, it's not coming as a surprise. We've all been in this space many a time. The significant issue this time around is the extent of steepness and the extent of depreciation. We know it comes under the various difficulties that the general economy is facing. However, it comes as no surprise, considering that the structure of the economy hasn't changed drastically to accommodate the stability of the city. Invariably, in terms of export drive, that will generate enough foreign exchange to avert the existing crisis that comes on year in, year out.
Well, when I spoke to you earlier, you asked what's new. The point being that it appears we do not have a solution, or if we do, it is not working. You talk a lot about boosting local production. You talked about export drive, but it appears it's just a talking point and no major action taking place.
That's why I use the word it's a cyclical issue, and anybody who playing in this industrial space or trading in the private sector experiences this. Yes, we've had a number of interventions by the existing government to bring about the structural transformation that is needed in the medium to long term to correct these imbalances. Yes, as much as the government made some significant effort in the first tenure until the events of COVID and also the Ukraine-Russia war, these events keep coming in, year out. The remedy that we have stated year in, year out is to beef up the industrial sector and focus more on the export-oriented production to avert this engagement of this cyclical issue that comes in year out, and other strategic policy interventions that we have advocated on many a time that are weakening the industrial base and making the industrial agenda inconsistent with policies that have been churned out sometimes. That's why I asked the question, what is new? What is new in this time is the extent of steepness and the extent of the depreciation amidst coming out of the COVID and also the Ukraine war that has led to a lot of distortion in our supply chain variables that we are grappling with as businesses.
The Ghana Union of Traders Association, the group you have disagreed with over the benchmark value policy, is calling on government to reconvene the Foreign Exchange Committee to provide some leadership and guidance, if you like, as far as stabilizing the cedi is concerned. You think it's a good idea?
Well, we are of the opinion that there is an institution as the Bank of Ghana that is mandated to engage on the stability of the exchange rate or price stability. It's one of the clear mandates of the Bank of Ghana, and an institution which has been tried and tested over the years has the capacity to engage in this space. So it isn't a matter of putting together another committee to do that which the BOD should know how to do best. So our point is that we want practical solutions that would bring about stability in prices. And since that is the mandate of the BOG, we should hold the BOG to get us remedies on this front, not necessarily forming another bureaucratic organization or committee to explore that opportunity.
In the short term, my final question, how are industries managing the impact on the operations? You have to think about sustaining your business, keeping workers, and ensuring that consumers are getting fair prices.
Well, in such circumstances where you have an existing contract with your customers, you might need to go back and renegotiate your contract terms in terms of pricing and then also in terms of payment arrangements such that you could show your cost price. Unfortunately, this extent of steepness might force entrepreneurs and business owners to pass on the price to the final consumer. That might not be the wish of most organizations. However, where you believe your cost rationalization would give you the space to still be competitive, you might need to explore that to keep your market share of the business in the economy so that you can still survive in times like this.
Well, we'll keep watching. Wish you all the best. Dr. Humphrey Mdake, thank you so much for speaking with us, President of the Association of Ghana Industries. Now, moving away from the cedi, auditing and accounting firm Deloitte is advising government to reduce its reliance on the international capital market and switch towards concessionary loans to reduce the country's exposure to the growing debt stock. Data from the Bank of Ghana puts the country's total debt stock at 393.4 billion cedis as of June 2022. The following report takes a look at proposals made by Deloitte Ghana after assessing the 2022 media budget.
According to the report, even though government was able to maintain all expenditure items within the budget, government, however, paid high interest rates on Ghana's loans due to the depreciation of the cedi against major trading currencies, as well as higher cost of borrowing in the domestic market. The report recommended that government should consider reducing its reliance on the international capital markets and switch more towards concessionary loans in order to contain the rising interest expense. Additionally, the auditing firm proposed that funds borrowed from the international markets should be invested more in capital projects with the ability to boost foreign exchange earnings and increase foreign exchange reserves. This, Deloitte says, will help absorb some of the foreign exchange shocks, accounting for the increase in interest expense. The report also pointed out that the need for fiscal consolidation, coupled with prudent spending, is key to restoring macroeconomic stability and growth prospects in the medium to long term. Hence, government must direct its expenditure to sectors of the economy that will help create jobs.
Well, partner Deloitte, you're allowed to join us on Zoom for more on the assessment of the media budget and the way forward. There's a lot to cover. We can't cover everything, but we'll tackle the aspect of debt, Yao. And it appears Deloitte is not impressed with government's current debt management strategy. You're calling for a much more comprehensive one. What would that entail?
Yeah, so thank you very much. I think our report came just in time, particularly when the country has been downgraded by S&P. to Triple C. That's because, as noted by the rating agency, we have limited access to the international market, and maybe we don't even have access to the international market in the short to medium term. And the reason being that historically, over the last few years, we have always relied on the international market to support our budget expenditure. And now that we don't even have access to the international market, the rating agencies think that we are going to struggle to meet some of our targets. So as a firm, what we are suggesting to government is that, look, we are in a situation that we find ourselves in because we have relied on external borrowing. And the effects of the external borrowing are two. One, you have exposure to exchange rates because they are denominated in USD. And two, you would have to pay high interest rates on these international borrowings. So I think what we are suggesting to government is, in addition to the revenue measures that were highlighted in the budget, the fact that now the election bill has been passed, the fact that we have the e-levy, the fact that we have the electronic VAT system, government should also look at some concessionary borrowing or borrowing that has got relatively cheaper terms. And this is coming at the right time because with our IMF program, we can use that to go back to our creditors and restructure our debt to a much more favorable term, because now you are under an IMF program. The reason or the argument that you can make is that with an IMF program, you will be more prudent with some expenditure, and you will have the IMF program helping you guide some of the areas that you spend your money.
All right. So the report advises government to look at concessionary loans, as you point out, rather than go to the capital market to borrow. Is that realistic, looking at the fact that there is tightening liquidity all over the world due to the COVID-19 pandemic and Russia's invasion of Ukraine?
It may be realistic, and particularly, the first entity that we reach out to is the IMF. And the IMF external credit facility is going to be a concessionary terms. And beyond that, beyond the IMF, you can ride on the back of that to restructure existing debt. There are some debts that we have with some multilateral agencies that are relatively more expensive if you look at what we get or how much we are paying on the Eurobond. And so, in my view, we shouldn't be borrowing at 8%, 9%. We should be looking at about 3%. And so, if you go back to our creditors and say that we are under an IMF program, we are ready to restructure our debt, either you increase the tenor of the payment or reduce the interest on these facilities, it will help us a lot. I'll give you a very frightening trend that in the first quarter of the year, if you look at how much money we make revenue of 16 billion. Out of that, we paid about 63% of that in interest payment alone. So 16 billion, we paid about 10 billion of that in interest payment in the first quarter of the year. This can continue. We would have to restructure our debt by looking at how much we are paying in interest on our debt. And I think that's something that we've advised government to look at, and it's something that's going to help us as a country.
One other thing of interest, you highlight the existing competition between government and private businesses for funds on the domestic market. What problem is that creating, and how do we solve that?
So today, the T-bill rate, I think the problem is just as obvious as we can see today. T-bill rate is about 26%. So T-bill rate that a few or a couple of months ago was about 15 or 16%. It's now 26%. What that means is that funds that ordinarily should have been available to businesses, I'll rather go and put the fund in a T-bill rate, or I'll go and invest in T-bill. In other words, I'll give that money to government than giving it to somebody who is doing business, which is a lot more riskier than giving the money to government. And so if that becomes the case, funds that are supposed to be available for businesses will be competing with government. And I think people will find, and even financial institutions, banks in particular, if you look at the financial statements of both of the banks in Ghana here, they are investing in government securities. That's because they find it a lot more secure and a lot more safer than giving it to business. And that's a worrying trend if you really want to transform the economy using the SMEs as the engine of growth. Well,
so the mid-year budget, does it provide any hope in curtailing our debt crisis?
Certainly it does. And I think government has reiterated in that the budget statement that they are working on the enhanced domestic program. What we will advise government to do is to accelerate the discussion and negotiations with IMF so that the program will come faster or will reach an agreement faster than is expected. Because a lot of the challenges we are having now is the loss of investor confidence and lack of policy credibility. And I think if we're able to have some IMF agreement, even before we sign on to the program, there will be some agreement in the next few weeks that is going to bring back some investor confidence and restore policy credibility.
Like I said, there's a lot to cover in your assessment of the media review. We'll leave it here for now, Yaolate, and we'll link up later on to discuss the other aspects of your assessment. Partner Deloitte Ghana, Yaolate, joining us for this conversation. Thank you. Well, you heard him talk about the IMF program. Well, there's new reporting we want to share with you that Ghana could secure a program from the International Monetary Fund in the second quarter of next year. The program, which would be spread within 3 years, could come with a total financial package of almost $10 billion from the IMF and other sources. That's the latest assessment by the fund based on its preliminary data on the economy. Here's George Affe with more.
Joy Business is, however, learning that this would be subject to the executive board of the IMF approving some of these proposals. Again, the economic data gathering is still ongoing. Therefore, things could change in the last minute in terms of the proposed schedule for the program to take off. However, about the number of years needed for the necessary economic correction, that wouldn't go beyond 3 years. On funding that will be allocated to Ghana's program, the country could get at least $3 billion exclusively from the IMF for balance of payment support. The World Bank could also be bringing some funding assistance on board to support projects identified in the budget that could come in the region of $3 to $4 billion. We should also not forget about the other donor partners that will come on board because Ghana has secured a program with the IMF, as well as the other financial assistance that will come from the open financial markets and investors. Now that could be more than $10 billion. But this wouldn't be a one-time disbursement, but rather spread over 3 to 4 years. In a related development, the IMF technical team is expected in town in the coming weeks to carry out some assessment in the areas of revenue mobilization and taxes. We are also learning that the government is yet to officially table its enhanced domestic program that should guide ongoing negotiations for a program with the IMF.
Associate Professor of Finance at Andrews University in the U.S., Dr. Williams Pepa, joins us to discuss this. Good to have you on the program. Now that everything concerning the economy is dependent on the IMF program and how quickly we are able to finalize a program, is second quarter of next year quick enough?
Daryl, for calling me. I think that second quarter of next year probably will be a little bit too late for Ghana because if you look at the data that was issued out by Bank of Ghana, already our balance of payment is in a negative of about $2.4 billion, which is about 3.5% of our GDP. Our revenue generation internally is not picking up as expected because the e-levy has failed. So if the fund delays, the impact will be very dire for us as a country. I noticed also, based on the report, is that government is also a little bit slow in submitting its own program to the fund. And this probably may be the reason why the fund will delay, because initially it was anticipated that any amount that will be approved for Ghana should come in within the first quarter, because if you don't get the funds coming in the first quarter, already there will be a lot of claim payments by companies within the country, and then also government's own commitments in terms of paying off some of the Euro bonds, which will be due, will be a major challenge. Though government is expecting about first the 750 million to hit the Bank of Ghana's account, and then also the cocoa syndication loan of about 1.5 billion. And putting this together gives about roughly, say, 2.35 billion US dollars. It will not be enough because currently we are already in a negative of 2.4 billion. So the fund, if they push it too much to the second quarter, our CD will devalue more, which we may have to see how to address it, because this will be an impact. Probably I'm expecting that maybe the central bank will come out with some measures to compel most of the companies that are involved in exports to bring in some of the monies that they keep outside the country. In our laws, we allowed free zone companies and these multinationals who are involved in exporting products from Ghana to keep some of the funds outside of the country. I think it's time that central bank will have to have some negotiations with them, so that when they sell the goods outside the country, they will bring in the proceeds first before they start to pay their suppliers. There must be a kind of balancing act between the central bank relationship with multinational companies in the country. This must be deepened. If you're able to deepen that relationship, probably it will stop the capital flight, where we have seen that a lot of companies are now sending their money out of the country. Based on the data from Bank of Ghana, roughly a net effect of about $1 billion was sent out during the second half of this year. And this is not good for the country.
Yesterday, when the president spoke, he said he expected a program very soon. So second quarter of next year makes you wonder why the hold up in tabling the enhanced domestic program. But we're also expecting some good cash from the fund and some other sources, $10 billion. Just wondering, enough to bring the much needed stability and confidence we want in the economy. Plus, your thoughts as the IMF team comes to the country next week, what would this next engagement entail?
Thank you very much. So, though we have heard of the promise of some institutions coming into, based on the IMF negotiation, coming to help the country with about this 10 billion, probably they will be looking at areas that they need to support, where they think that will be able to turn out the economy. If I'm going to do a simple analysis, all these institutions and IMF coming to help Ghana with 10 billion, they are coming in because of an interest of companies that represent their countries. For example, Daryl Oil is a US-based company. Daryl already purchased about 80% of their transactions are held by US firms. Only 20% are in the hands of Ghanaians. Should Daryl not be able to find foreign currency from Ghana to pay these firms in the US, it's going to be a problem. That is why these institutions are coming in to make sure that Ghana have the funds to be able to meet the demands on our international reserves. This is very critical. The impact is that if Ghana fails, or the central bank fails to have the dollars to give to any of the companies, it will have a ripple effect in other countries. And that is the reason why probably they are coming in. And these funds probably will be specific. We know one, which is the energy sector, especially the oil industry. And I've mentioned also maybe the extractive sector for the gold and diamond industry. They will need a special arrangement, the central bank, to be able to make sure that
we have just 30 seconds
to go. Also, on the part of government and delaying, I really don't understand why the program is delaying, and we hope that probably whoever is working on these things, they will be able to work fast, make sure that the document is sent to IMF.
Okay, and so I'm sure we'll have a conversation once the team arrives next week to continue with the fact-finding mission, and also, I mean, settling issues concerning tax situation and other information they really need for us to carry on with this program. Thank you so much, Dr. Williams Pepra, Associate Professor of Finance with the Andrews University. I appreciate your time with us. And that's the marketplace. Thanks for watching. There is more news on our website, myjoyonline.com/business. Head there for the day's latest, including the latest on the IMF financial package as being reported by Bloomberg as well. Also, the price of cement going up to hit 68 cedis a bag. That's some worrying news. myjoyonline.com/business. Thanks for watching. My name is Daryl. Goodbye.